February 6th, I published a video telling you Rezolve AI was setting up for a major reversal. Then the stock ripped 15% in 3 days. But here's what nobody saw coming. While retail traders were patting themselves on the back for that quick flip, BlackRock quietly added millions of shares. Goldman Sachs increased their position by 340%. Morgan Stanley came in heavy. The institutions weren't selling into that rally. They were buying aggressively. I'm Smart Stock Sam, and today we need to talk about what happens when Wall Street's biggest players surge their ownership by 480% in a stock that most people have never even heard of. This is Rezolve AI, ticker RZLV. The current price is $2.27. The Wall Street consensus target is $9.11. That's a potential 400% move. But the real question isn't whether this stock can hit those targets. The real question is, what do these institutions know that we don't? And more importantly, are we about to witness one of those rare moments where everything aligns perfectly for an explosive move higher? Right now, something rare is happening with RZLV. We're seeing what I call the perfect storm, a convergence of 3 massive catalysts all hitting at the same time. You've got fundamental expansion through a $230 million acquisition that transforms the business model. You've got institutions piling in like there's no tomorrow with conviction buys. And you've got a technical setup that's forming a textbook triple bottom with major support. The current price is sitting around $2.27. But Wall Street's consensus target is $9.11. That's over 300% upside on paper. Now, before you rush to hit that buy button, ask yourself this critical question. If this stock is really worth $9, according to the smartest analysts on Wall Street, why isn't it already trading there? What do these Wall Street firms with their armies of analysts and insider connections know that the average retail trader scrolling through Reddit doesn't? Let me take you through the critical timeline. On February 6th, we predicted a technical reversal. The stock ripped 15.33% from its lows. Then, on February 11th, the acquisition got officially confirmed. But instead of rallying, the stock dipped because of governance concerns about the CEO. Fast forward to February 12th, those ethical red flags were cleared during an investor call. But here's the question. Was that dip just noise or something more serious? Let's talk about the acquisition, because this is the foundation of the entire thesis. Rezolve closed a $230 million all-cash deal to acquire Reward Loyalty UK. Now, I know what you're thinking. $230 million sounds like a lot of money, but here's what that money actually bought them. Immediate access to 100 million cardholders across major markets, direct integration with Tier 1 banks like Barclays and HSBC that have millions of customers. And most importantly, it completes their technology stack by bridging their AI commerce engine with the actual payment rails that people use every single day. This isn't just some strategic add-on that sounds good in a press release. This is the missing piece that transforms Rezolve from a promising tech company with great ideas into a fully integrated commerce platform that can actually generate serious revenue. But acquisitions are only as good as the money they make, right? So what does this actually do for the bottom line? Here's where the numbers get interesting. Before this deal, Rezolve had $209 million in contracted revenue. The Reward acquisition brings in another $90 million. But the key word is accretive. That $90 million adds more to profits than it costs to run. The company hit operational profitability in December 2025 and is on track for full-year profitability in 2026. So we've got growing revenue, a path to profitability, and scale. Sounds perfect, right? Except there was one problem hanging over all of this. The governance issue. This was the elephant in the room that nobody wanted to talk about. CEO Dan Wagner had a personal stake in Reward Loyalty, the company Rezolve was acquiring. That's a massive red flag in the investment world. Investors absolutely hate conflicts of interest. It doesn't matter how good the deal looks on paper. If there's even a hint of self-dealing or insider enrichment, institutional money runs for the hills. But during that February 12th investor call, something critical changed. Wagner confirmed he divested his entire position in Reward Loyalty before the acquisition closed. The conflict of interest was eliminated. The governance overhang was removed. The cloud of doubt was lifted. Now here's my question for you. If that was the only major thing holding this stock back from reaching its fair value, and it's now completely gone, what happens next? Let's follow the money because institutions don't gamble. Goldman Sachs increased their position by 340%. BlackRock now holds nearly 10 million shares. When institutional ownership surges by 480% in a single period, that's conviction. These are people with the best research teams and data in the world, voting with their wallets. But what price are they targeting? Wall Street isn't being shy about their bullishness. Maxim Group has a price target of $15. Alliance Global is at $13. The consensus average is $9.11. From our current price of $2.27, that's over 400% upside. When was the last time you saw Wall Street analysts this aligned with price targets this high? But if this is such a slam dunk, why did the price pull back this week? Let's look at the price action because this is where technicals become critical. After the acquisition news, the stock peaked at $2.92. Then we saw volatility as the market digested the news. The stock tested critical support at $2.19. But look at what happened at the end of the week. Stabilization at $2.27. The selling pressure dried up. The bears ran out of ammunition. So if that floor holds, where are we headed? Here's your tactical roadmap for the week ahead. The buy zone is between $2.19 and $2.30. That's our zone of accumulation where risk is defined and manageable. If we break below $1.90 with conviction, the thesis breaks. That's our absolute line in the sand where we exit and reassess. To the upside, we've got some near-term resistance at $2.60 that we need to clear. But the real ceiling, the level that actually matters psychologically and technically, is $4. That was the previous private placement price, and it represents major psychological resistance where early investors might take profits. But here's what most retail traders don't realize about that $4 level. It's not just resistance, it's actually a trigger for something much bigger. This is the hidden metric that changes everything. Official short interest is around 13%, but the off-exchange short volume is 44%. There's massive hidden bearish pressure. Now think about what happens if we get any positive catalyst, a new partnership, better revenue guidance, anything. Those shorts are trapped and forced to cover. When shorts cover in a thin float stock, you get explosive moves higher, but it gets even better with the options market. We've got a gamma magnet forming. There's huge open interest in call options at the $3.50 and $5 strikes. Market makers who sold those calls need to hedge if the stock breaks above $3. That buying pressure pushes the price higher, forcing more hedging, which pushes prices even higher. It's a self-reinforcing loop called a gamma squeeze. We saw this with GameStop and AMC. The mechanics here are identical. So how do we play this? For the week of February 16th, here's the game plan. We're looking for a precision entry in that $2.19 to $2.30 zone. That's our triple bottom support area. Our first profit target is a mean reversion back to the $3 to $3.25 range. Our second target is that $4 psychological resistance level. And critically, our stop loss is a daily close below $2.19. No exceptions. We protect our capital first, make money second. When you map this out, the math becomes really compelling. Before we wrap up, I need to be crystal clear. Nothing I've shared is financial advice. I'm not a licensed financial advisor. I'm sharing my analysis and opinions. You need to do your own research, understand your risk tolerance, and make your own decisions. Trading stocks, especially volatile small caps like RZLV, carries significant risk. You can lose money. You can lose all of your money. Never invest more than you can afford to lose. Never invest with money you need for bills or emergencies. If you're not comfortable with volatility and risk, this isn't for you. Always consult with a licensed financial professional before making investment decisions. Look at the risk reward here. Your downside is defined by that $2.19 floor. Your potential upside is a gap fill to that $9.11 analyst consensus. The ratios are lopsided in favor of the bulls. This is the asymmetric setup that professional traders live for. Low defined risk, high potential reward, strong catalyst, institutional backing, technical confirmation. So what's the final verdict? Here's my take. Rezolve AI is a coiled spring. The fundamentals are locked in with a game-changing acquisition. The smart money is aggressively accumulating shares. The technicals are primed for a potential gamma squeeze. We've cleared the governance hurdles. The path to $9 and beyond is wide open. But as with any trade, we follow the plan. We respect our stop loss. We take profits when targets hit, and we never let emotions override our strategy. If you found this analysis valuable, smash that like button. Subscribe to Smart Stock Sam for more data-driven breakdowns. Drop a comment below with your thoughts on RZLV. Are you buying the dip or waiting for confirmation? I'll see you in the next one.